Hello, Business 330 students. This is Professor Hassey. It's our week 4 lecture video. Today is Wednesday, June 30th, the last day of the second quarter. So many of our portfolios will go under some scrutiny this week. You have a discussion post this week for the close of the market this Friday, July 2nd. You revalue your portfolio, and I'll talk about that in just a minute. Our topic this week is capital valuation, which mainly means bonds and stock, the two major sources of capital for corporations. As I was saying, you have a discussion post this week due Sunday, July 4th. And again, as I said in my introduction video for this week, I apologize for work over your holiday weekend. Not much I can do about it, but that's the way it is, and I apologize. Our second assignment will be posted next week, due July 11th. I will post the assignment 1 grades this coming weekend, probably on Saturday, for you to review and see how you stand. Remember, next week we're heading into our 5th week or halfway point of our course. Make sure all your grades are accounted for and you understand them. Assignment number 1, the original portfolio work you did, and your professor meeting. If there's still holes there and still things are not posted in your Blackboard, make sure you checked in with me and make sure we get those cleaned up here in week heading into our halfway point of our class. Here's our Blackboard, a couple things of interest in our Blackboard for this week number 4. First of all, I'll be going over a spreadsheet in just a few minutes, and here's that spreadsheet located here in your in-class review file folder. You can download that, and there's some examples of bond and stock valuations, which we'll talk about those in just a minute. You also have a week number 4 discussion portfolio. You are to update your portfolio for this Friday, July 2nd. Again, you need to submit your spreadsheet file to this file folder. You to determine the stock price of July 2nd, and then update the total, update the 3 market indexes, and what is the percentage change in your total portfolio and indexes from the original valuation. Also, I need you to create a new column in your portfolio, entitle it Beta, and I want you to locate the current beta for your portfolio companies. You can find that in Yahoo Finance. You can find that everywhere. And we will discuss this in our next class video in week. We will discuss that tonight, but more importantly, next week in week number 5. So here's what my portfolio will look like. Let's bring this up so you can use this as an example. Remember, you all have your portfolios already done for the first part of our class. What I've done now is I've just taken my original portfolio, like you all have right here, and I copied it, Control C, copied it down here, Control V, and now I have a copy down here. But another thing you need to do, see, this original portfolio took your investment, divided the price on June 11th to determine your shares, okay? Well, this next portfolio is going to take your price on July 2nd, and you're going to multiply it times your shares to determine your new valuation. So in order to do that, you have to take these shares in your original portfolio and copy them and come down here and paste them as values. Paste as values. You don't want the formula from last week down here because you're going to be putting in a new formula this week. So I paste them in values, and notice, here's Apple. I had 196 shares last week. I rounded to the nearest whole share. I took the formula G6 divided by E6, and that's how I got the $196. Now, this week, I copied the value down here. Here's let's say my new stock price on Friday is $128. Then in your dollar column, you're going to take the price times your original shares to get the new value. Notice here, E16 times F16. There's my new value. So now I've gone from 25,000 to 25,127.60 in these first few weeks of our course. So you're going to do that for each one of your stocks. taking the new price times your original shares to get your new value. And notice what I've done. According to this example, because naturally it's not July 2nd yet, I now have 99,000 as a value. So what I do is I take the difference between my July 2nd value and my original 100,000, and that's my loss. I've lost $772.53 in this example. Then I take that number as a percent of 100,000 to get my percentage change. This divided by this gives me 0.77, and that's my loss in a percent. So in this second version of your portfolio spreadsheet, you have your new values, your new total, and then the difference between your original portfolio and the new one. In this case, it's a loss, and I want you to put that in a percentage. Then you find the new values as of Friday of the Dow, the S&P 500, and the NASDAQ. And again, take the differences between July 2nd and June 11th. There's the total difference there. And I determine the percent of that change by taking that difference, dividing it into the original amount to get my change in that. So notice I had a loss here in this example, but then I had gains in S&P and NASDAQ. These prices here, matter of fact, are of yesterday, Tuesday. So you'll update them as of Friday. But I want to see how your portfolio has changed versus the market indicators. In this example, I'm not doing so hot. Even though the Dow lost, they didn't lose as much. I'm doing worse than the Dow and much worse than the S&P and the NASDAQ. I should have stuck my money in those funds. I'd be a lot better off. I want to see that this week. And then you're going to create a new column in this week and call it beta. And then you're going to go and find the beta for each one of your companies. Now, some of your companies might not have a beta because they're new, or maybe they've had multiple losses over the last couple of years. That's okay. Just put NA, not available. But here's what I do. You go to Yahoo Finance, you bring up Apple, you'll see in the summary page of Apple, it'll list the beta for Apple. Right now it's about 0.7. So I would type it there. There's the beta, not put that in dollars, just put that in a number, 0.7. GameStop, Viva, Clean Harbors, or whatever company you had, I want to see the beta. Remember when we're going to do the capital asset pricing model form evaluation, and we'll talk about that next week, is that now we're going to see what the risk of that particular company is in the market. Average risk is 1.0. Below 1, better risk. Above 1, lousy risk. I can put that in context. An average FICO score in the market right now is about 575. That would be like a beta of 1. If you have a FICO score of 700, then your beta would be 0.5, better than market. If your FICO score was 450, it'd be 1.5. You have greater risk. So that's kind of how you can equate to that. But beta is a statistical calculation, and we'll talk about that in the future class. But I want you to find the beta for your companies. If you can't find it, just put NA. But make sure you can't find it, because I look all these up, and if I find a beta for you, you'll get points taken off for that. So that's what I want your portfolio to look like this coming Friday. Posting it back to that discussion forum, I want to see 2 schedules, your original and the one for July 11th. The main point is, how has your portfolio changed since June 11th? That's what I want to see. So that's what I want you to do for the discussion forum for a grade for this week. Okay, our main topics this week is what is stocks and what are bonds? The main form of financing for corporations. Individual companies, small businesses, proprietorship, partnerships, small corporations. Bonds and stocks are not an option. Too expensive. You have to hire investment bankers, lawyers, accountants, representatives, and you have to go after big money. A lot of individuals, a lot of pension funds, a lot of insurance companies will not lend money to small businesses because it's too risky. A lot of people will not buy or buy stocks in small companies. It's too risky. Thus, small businesses go to banks for financing. They go to Shark Tank to get private investors. They go to venture capital funds. They go to LeBron James. They go to their families. They find equity in their own money. That's how they raise capital. But this is corporate finance. So we're going to learn about bonds and stocks, the two main funding for companies. This is where they get their money. What is a bond? A bond is a lending of money by the public. The public markets of bonds lend corporations money. And the credit rating of the corporation determines the interest rate or the coupon on the bond. Bonds have maturity dates. The nice thing about bonds is the company only has to pay interest until maturity. At maturity, they pay all the money back. Until then, they just pay interest every year. All right. So let's have an example. All bonds are in $1,000 denominations. If I want to buy a bond in a company, I'm going to lend them $1,000. In return, they give me a coupon, and the coupon would be on the bond. Let's say in this example, the coupon is 5.25%. So 5.25% of $1,000 is $52.50. And let's say this bond is maturing in 10 years. In other words, the company's going to go to the public markets and borrow $1,000 from each person or each entity that wants to lend them the money. In return, they have to cut them a check every year for 10 years for $52.50. Then at the end of 10 years, they have to pay back the $1,000. Now remember, this is a corporation, so they're going to be issuing a lot of bonds. All right, a lot of bonds. $100 million, $1 billion, a lot of money. So that's a lot of interest payments. But that's how that works. All right. The bond is determined by the company's credit rating and the demand for demand in that company for people to lend them money. That's going to determine the coupon rate. Sometimes you hear the expression, the company is a junk bond. A junk bond indicates that that company has lousy credit and they have to pay a very high interest on their coupon. The maturity dates are also set by the agreement between the markets and the company on what attracts investors. Okay, I'll lend you $1,000, but I want that money back not in 20 years, I want it back in 10 years. And the company says, okay. So what companies do with this money is they immediately get it from the market after they pay their investment bankers and their attorneys and their accountants who help them raise the money. After they pay them their fees, they take all that that cash flow that they got from issuing the bonds and invest it in assets and make sure those assets are managed to pay off the interest every year and make sure they accumulate enough wealth in those assets to pay off the bonds at maturity. That's the bond market. That's how it works. Now, what happens when you want to maybe get rid of your bond after you lend it to somebody? Well, that doesn't usually happen very often because why do people invest in bonds? Fixed income. One of the things that's attractive about bonds, a lot more than stocks, is when you invest in a bond, you know exactly what you're getting. In the case of this example here, I'm going to get $1,000 back in 10 years. Plus, over 10 years, I'm going to get $52.50 a year in interest. You know exactly when you're going to get paid and how much. In stocks, it's the direct opposite. You never know when you're going to get paid. You never know. You can't predict how the company's going to do with their stock price. You don't even know when they're going to pay dividends. It's totally unknown. That's why the risk is so much greater for equity investment than it is for bond investment. That's why interest rates, one of the main reasons why interest rates are so cheap now. The demand for cheap money, bonds, is low, so interest is low. With inflation hitting up, that might change, but for now, money is cheap. So that's what bonds are. And how bonds change in the marketplace is this. If interest rates go up, if inflation heats up, existing bond values will go down. And if interest rates go down, existing bond values will go up, which is the common rule for asset values. Remember, asset values, which an asset will be an asset for an investor. A bond investment is an asset for an investor. It's a liability for the company borrowing the money. But asset values increase when money is cheap. Asset values decrease when money is expensive. Okay. Why are housing markets getting pretty high now? Supply and demand, yes, but also inflation's heating up. All right. Inflations are heating up. Property values are going up. One of the most things about that is because the asset value that's producing that revenue is going to be changing in value. So one of the key things to remember in investment management, money is cheap, that asset is going to have more value because it's going to produce a greater return over the cost of the money. If money gets expensive, that asset is going to decrease in value because the return generated off that asset's got to pay more out in interest. And that's what drives the bond market. People are going to invest in bonds because it's a sure thing and they know they're going to get fixed income for a period of time. But if interest rates go up, the value of that existing bond is going to decrease. Why? Because if interest rates for this bond, let's say, go up to 6%, if the current yield becomes 6%, who would want to buy a 5.25% bond? I'm going to want to buy a 6% bond now because I'm going to get more income. Why would I want to go out and buy an existing 5.25% bond? So in order to sell those bonds in the market, they have to go down in price. And that's why prices drop in high inflation for bonds. So people are right now a little skittish in the bond market. And how do you calculate that? All right. It's a present value calculation. Let's say in 2 years, I decide to sell this bond in the market. 2 years. So 8 years remain on the bond. The yield in the market now for this type of issue is 6%. That's called the current market yield. In other words, 2 years after this was introduced at 5.25, the market has changed on that similar type of security. So if I wanted to sell this 5.25% bond in a 6% market, it's going to be less than $1,000. Formula, function, present value. The current rate in the market is 6%. The number of periods remain are 8. Remember, after 2 years, I'm trying to sell this bond. It's a 10-year bond. 8 years remain. I'm getting a coupon payment of $52.50 every year. And its future value at maturity, I'm going to get $1,000. What is the value of this bond now? In a 6% market, I'm getting 5.25% money. Notice it's gone from $1,000 to $953.43. That's a perfect example using a calculation with the present value of money that the asset value of this investment of $1,000 has now gone from, is now gone from $1,000 2 years later to $953. Why? Because the market money has become more expensive. The yield in the market has gone up. Thus, this 5.25% bond, in order to attract a buyer, you got to sell it at a discount. That's called a discount. Let's say the current yield it drops to 5%. What is that bond now where the interest rate has decreased? Money is cheaper. Formula, function, present value. The rate now in the market is 5%. Still 8 years remain. Still the coupon is $52.50. Still the maturity value is $1,000. But notice the bond now is at a premium. It's above $1,000 because the interest rate has dropped. Two typical examples of the bond market. You buy the bond, or get the money or lend the money out to a company. You keep it for 10 years, you get $52.50 a year and get your $1,000 back in 10 years. Sure thing. If the company can't make those payments, they go in default. They have to sell assets to pay you. You still get your money. But if you decide to sell that bond in the market before maturity, the current yield in the market will drive how much you can get for that bond. A discount, if the interest rate, the current yield goes above the coupon, at a premium if the current yield goes below the coupon. Two fundamental factors of the bond market. Why this is important to know, not so much as an investor, because most of us, when we buy bonds, we hang on to them. But what it means, it's a good example of how asset values change as yields change. And right now on all the news broadcasts and business, you hear yields are increasing. Money is becoming more expensive with inflation. And when yields increase, prices go down. That's a good thing. That's a key thing to remember. And that's how it applies to debt financing for companies. Chapter 7 talks about stocks, which is a whole nother situation. Bonds, we know, as I said earlier, bonds, we know exactly what we're getting. Stocks, we have no clue. We go to Robinhood, we go to our broker, we go to E-Trade, and we buy a stock. Why do we buy it? We hopefully can get dividends, and hopefully the company's performance in the future has the stock price going up. Either way, we get paid for that. We get a check for dividends on a quarterly or yearly basis, and we have to sell the stock to get the appreciation value of the stock. If we don't sell the stock, we don't get anything. All we get is dividends, is cash. We have to sell the stock to get our money. All of those, when we buy the stock, we have no idea what the future is for that. We have no idea. We can look at past performance for dividends. We can look at past performance of how the stock is trending up or down, but it's not a guarantee of what's going to be given to us in the future. With bonds, you know exactly what you're getting, and that's a key determinant. That's why most companies finance by debt, because they know what they have to pay out. Right up front, they know when the dividends are due. They know how much maturity they have to pay back in the future. Stocks, it's based on performance, their performance. If they don't do well, cash flow, profits, the stock price is going to go down. They won't be able to pay dividends. Bad. That's the key difference between stocks and bonds. Unknown stock future, guaranteed future with bonds. So companies build their operating budgets and their cash flow estimations, and we'll talk more about this later on in class, based on bonds because they know exactly what they have to pay back. That's why most companies, their capital structure is a majority in debt. because it can be controlled. Now, sometimes you get too much debt, and if your company slows down and starts and not making any profits, that debt you still have to pay. Then it becomes a burden. With stock, you can tell your stockholders, well, we're just going through a bad time. We're not going to pay you a dividend this week or this year. Hang with us. We're going to come back. Perfect example of that is Tesla. Tesla doesn't make any money. They lose billions. Oh, I should check that. Now they lose hundreds of millions. They used to lose billions. But why do people still keep buying the stock and holding on to it? There's no dividends being paid. It's the future expectations that Tesla is going to turn it around. They got a hotshot CEO in Mr. Musk, and they got a hotshot technology and cool products. Eventually, they're going to make money. So investors are willing to wait, and that's what Tesla's all about. Other companies like General Electric, who've been around since the 1870s, their investors can't wait. They don't want to wait. We expect profits every year. We expect dividends every year. We expect stock prices to go up every year. So companies like General Electric, they better perform, or as you can see with their stock price over the last 5 years, it lays flat. It hasn't done anything because investors aren't getting what they want, so they're getting out of there. Tesla is a different market, a different technology, a different management. And that's what's so interesting about stock selections. And that's what we're going to see in your companies in your portfolio over the next remaining 6 weeks of our course. Why do they go up and down where other companies don't? What's their secret? And we're going to be looking at that. When I talk about bonds, we look at interest, and it's usually fixed. You know exactly what you're getting. Stock is all based on expectations. We hope the company does well. We expect the company to make money. Not guaranteed though. This is guaranteed. So the return on a stock is dividend plus capital gain. The dividend the stock company pays, share their profits to the shareholders. The capital gain is how the stock appreciates it. But in order to get that capital gain, you got to sell it and then you no longer own it. Okay. So let's say I have a stock that has a current price in the market of $22 a share. It has I sell the stock, which I purchased at $20, so I made a $2 gain. In the last year, it's paid me a $2 dividend. What is my return on the stock? Well, $2 gain, right? $2 gain and a $2 dividend, that's $4. What is $4 as a percent of my original investment? Sorry. $4 as a percent of my original investment? 20%. I made a return of 20%. But in order to get that 20%, I had to sell the stock. So my yield, my dividend yield was $2 as my original stock price of $20, excuse me. So my yield was 10% plus a 10% capital gain, thus my return is 20%. But I have to sell the stock to get the capital gain. I don't have to sell the stock to get the dividend. So it can get a little complicated. During the course of the next couple of weeks, your companies in your portfolio will be paying out dividends. We're going to go and find that out in future assignments. Now, why would I decide to buy a stock when I have no idea about the future? Well, I kind of have an idea about the future. Why? Because it's required by law that all public corporations have to, every quarter, estimate what their future returns are going to be. Every quarter, like for example, our quarter ends today, June 30th. In the next 2 weeks, the companies will be announcing their quarterly earnings and results and their projections for the next 12 months beginning July 1st. The Securities and Exchange Commission requires this done every quarter by every publicly traded company. So when that happens, you can go to their projections and see what they expect to happen. So let's say a company currently is going to pay, they plan on paying a 75-cent a share dividend in the next year. They say that we expect to pay a dividend of 75 cents. Doesn't mean we're going to pay it, but we expect it. For the next year, we're going to pay a dividend of 75%. We expect the company to grow in the next year at 7%. Again, they have to say this every quarter. And let's say in the market, investors expect a 9% return off this company. That's why they're buying the stock. They expect a 9% return. There's a little discussion in chapter 7 called the constant growth model. You can determine what the stock price is based on these planned expectations and results of the company for the next year. So let's say it's the middle of July and the company says, beginning July 1st for the next 12 months, we're going to pay a 75-cent dividend. Our company is expected to grow by 7%, and we know in the market that our investors expect a 9% return. What is our stock price value as of June 30? Not its true market value, but what is its value based on these expectations? It's called the constant growth model, which takes the future dividend, in this case 75%, or 75 cents, and divides it by the expected return by investors minus the expected growth of the company. So 75 cents divided by 9 minus 7, which is 75 cents divided by 2%, I get $37.50. That's based on this future projection. That's what we think the company's price of the stock should be today, $37.50, based on these future expectations. It's called the constant growth model. Next week in July, as all these results start coming out, this is when the computer logarithms go into high mode in stock brokerage firms, in Robinhood, in E-Trade, in all the Schwab and all the trading functions and brokers. They go bananas because now the actual numbers come in for the second quarter, June 30th. We can project out what we think the stock is worth. So let's say we do this like here, and it's $37.50. Well, I call up my broker on July 1 or June 30th or whenever, and he says the stock is currently trading at $40 a share. The current market price is $40 a share. Would I buy that stock? Would I buy that stock today at $40? And its true value based on the projections is $37.50. Would I buy that stock? Hell no. Why? It's only have a value today of $37.50 based on its future dividend payout and expected growth based on my expectations, and it's at $40. Why would I buy a stock that's worth $37.50 for $40? This stock is what you call overvalued. But I call up my broker, and my broker says the current price of the stock in the market now is $30 a share. Would I buy the stock today if the market value is at $30 a share? And the answer is yes. Why? The stock is considered undervalued. Based on the company's projections, we think it's worth $37.50. But the market thinks its stock is worth $30. I would buy it today at $30, knowing that the price is going to hopefully go up to $37.50 rather quickly. And this is what drives Warren Buffett to make money. He has University of La Verne MBA graduates crunching the numbers every quarter saying, find me the undervalued stocks and I'm going to buy them. And that's when a broker calls you up and says, hey, I recommend you buy Apple. And you say, why? And the broker says, because we think it's a good buy for you. Yeah, but I just ran my numbers and it's overvalued in the market. Why would I buy it? And then all of a sudden the broker would go, damn, you've had Professor Hasse in finance. I can't mess with you. You know what's going on. Because the stock is overvalued. Why do I want to buy a stock that's worth more than it really is worth? Welcome to market trading. It's all based on future performance and your expectations, whereas bonds is based on fixed payments into the future that you know you're getting. So the next question would be obvious for most of us is why would you want to buy a stock when everything's up in the air? Risk. You can make more money if you're right. Wouldn't you usually rather go play craps in Vegas instead of blackjack? Why? You can make more money quicker for the same amount of investment. You can put $10 on a crap table and the game changes very quickly compared to $10 in a blackjack table. After an hour, maybe you're up $5. An hour of playing $10 craps after a while, you could be up $300. Naturally, you could lose it too. But the risk of return is greater with craps. That's what drives the stock market. When money is cheap, asset values are high, inflation is low, and coming out of the pandemic, people are going to keep buying into the stock market. Why? Today, June 30th, the market closed S&P 500 and the NASDAQ at record highs. People are still buying stock because they think and they hope that those expectations are still out there in the market. Welcome to the stock world on June 30th, 2021. The expectations are still greater for the risk. So people are willing to take that risk in the stock market. It's all based on your determination of does the company properly project out what they're going to do, and you're fitting that projection into your own risk aversion in your investments. But what company corporate finance people want to do is make sure they always understand what are the market expectations of our company and what are we going to produce in a return. And if those constantly are positive, you're going to keep getting money invested in equity because you're going to be outperforming the market. So our takeaway from this week number 4 in understanding bonds and stocks is I'm going to ask you a question in our assignment number 2 next week. Explain to me as an investor, what's the difference between a bond and a stock? Now, explain to me as a corporate finance manager, the difference between a bond and a stock. I think you can answer that question. Bonds are fixed income investments over a particular period of time. Stocks are equity or ownership investments where you have only expectations, not guaranteed money. But if the expectations are within risk management of your own particular standards, that's why we play the stock market. And we're going to see how your portfolios react to these market indicators, especially at the end of this current quarter today. And you're going to be looking at how your stock is on Friday after the results of the second quarter of 2021 start coming in and over the next subsequent weeks. So those are the key takeaways from chapter 6 and 7, the definitions and why we invest in stocks or bonds and why companies finance stocks and bonds either way. So we need to understand that. And we'll talk more about that next week in our assignment number 2. But you're also talking about a lot that this week in determining your current valuations of your stock portfolios. Remember, spreadsheets only, please, no PDFs. And you should know how to do it right now after our review of your work from the first time you went through this. Think about it. Spend a little time and do it right. In the long run, you'll learn off this as we proceed forward in this class. And don't forget the beta number. What is the risk in the market of that stock? I'm going to talk more about how that applies to what we just talked about next week. That's my lecture for week number 4. Halfway point of our class is next week. Another assignment, discussion post this week. Have a safe and wonderful 4th of July. Don't let off too many fireworks like those knuckleheads around my neighborhood do, scaring all the dogs and cats and kids. Really? Is that necessary? Go out to the desert and let them loose where there's nobody there. Why do you have to let M80s off in the middle of Bonita Avenue? Really? All right, that's my political commentary for the evening. Have a great weekend. Sorry about having to do the discussion, but this is important stuff. And we'll see you all next week. Look for your assignment number 1 grades this weekend. Adios.